Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Happy Thursday, everybody. Sadly, however, we need to begin by touching on yet another deadly fire in China. The fire broke out around 3:30 p.m. local time in a small city in Jiangxi province, in the basement of a building that housed an internet cafe on the ground floor and an educational center upstairs. According to state media, the fire killed 39 people and has injured 9. This is the second deadly fire in the same city in recent weeks. A fire at a shopping mall in the city on December the 21st last year took the lives of 2 people. The city's firefighters, quote, exposed 15 units with fire hazards on December 31st, 2023, after a rectification campaign was carried out in the same month, end quote, in the words of state media. Despite this campaign, however, as we can see now, there was another fire which was much more deadly. On Wednesday of this week, General Secretary Xi Jinping himself got involved, quote, urging efforts to curb the repeated occurrence of various kinds of safety incidents and stressed the various localities and government departments should draw lessons from the incident, end quote, in the words of state-run Xinhua. Okay, now let's move into the main updates, and we begin with the economy. In a bit of a surprise move, at a press conference to introduce, quote, the implementation of the Central Economic Work Conference's deployment and the situation of financial services supporting the high-quality development of the real economy, end quote, the head of the People's Bank of China, China's central bank, announced that the reserve ratio requirement, RRR, will be cut. The RRR, which determines the amount of cash banks have to keep in reserve, will be lowered by 0.5 percentage points on the 5th of February to provide 1 trillion yuan, $139 billion in long-term liquidity to the market. The bank reserves move, which is aimed at providing additional stimulus to the economy, marked a rare and transparent reveal of a policy change by the head of the People's Bank of China. Typically, the central bank announces it first on the website. It was also made during trading, suggesting that the timing and the way the message was delivered may end up being more important than the actual substance of the cut. State media, likely trying to excite markets too, called the policy measures rare and exceeding expectations. State-run Global Times writes today, quote, Chinese economists said the moves marked a significant easing in China's monetary policies and underscored policymakers' determination, as well as the capabilities to keep the world's second-largest economy on a steady recovery trajectory in 2024, despite lingering downward pressure, end quote. Wang Fenglei, founder of Huopu Investments, told the Asian Financial Forum in Hong Kong yesterday that the People's Bank of China's cut to the reserve rate was good news, but he was unsure if it would boost the capital market. UK-based Financial Times, reporting on the statement, added that he also expressed, quote, most importantly, they should cut interest rates as well because interest rates are still very high. High interest rates stifle consumption, end quote. Zhang Zhiwei, chief economist at Pinpoint Asset Management, said that the reserve cut was a, quote, step in the right direction, end quote, but called on the government to channel more funds towards consumption rather than industry. Kevin Nett, head of Asian equities at Tocqueville Finance SA, expressed, quote, a RRR cut helps sentiment in the sense that the action seems more decisive, but some investors may use this as an exit opportunity if there is such short-term market rebound, unless there are more policies to address structural issues, like those with the property market, end quote. At the same press conference, the People's Bank of China also announced the setting up of a so-called credit market department to focus on the so-called 5 major tasks, namely technology finance, green finance, inclusive finance, pension finance, and digital finance, which Xi Jinping laid out at the Central Financial Work Conference last year. Hours after the RRR announcement, regulators added more measures to bolster the slumping property and stock markets. They broadened the use of commercial property loans for developers to help them repay other debts, and gave a boost to China and Hong Kong equities by unveiling steps to deepen financial ties with the Special Administrative Region. Meanwhile, Beijing appears to be trying to say a lot to revive animal spirits in the markets. Of course, regular viewers will know why. China's stock market is in a terrible place. As we have explored this a lot in recent days, there's no need to unpack it again in detail here. We just remind ourselves that the mainland CSI 300 is at a 5-year low. This week, officials are coordinating their messaging to try and improve confidence. Chinese financial media outlet Yicai reports that in trading yesterday, the Shanghai Composite Index reversed a 1% drop to close up 1.8% after the China Securities Regulatory Commission head said it will focus on, quote, protecting the rights and interests of small and mid-sized investors while reminding listed companies about the required rate of return, end quote. The watchdog will comprehensively assess the IPO pricing and inquiry mechanisms to support greater investment participation and will improve the regime for quantitative trading based on national and city-level conditions, he said, adding that it will optimize rules for shareholders who want to unload stock, as well as those about margin trading and refinancing. Quote, this looks to be another sign of real resolve to at least put a bottom in for the stock markets. And beyond jawboning, policymakers can and will also do things like limit stock short selling and restrict access to funds that invest in offshore securities, end quote. In a special piece called Will China's Relaxed Share Buyback Rules Help or Hinder the Market?, Chinese financial media outlet Caixin argues yesterday that China's new rules on listed companies' share buybacks were introduced supposedly to shore up the sagging stock market. But, it writes, skeptical voices are growing, warning that the changes might in fact amplify market risks, deter additional investment, and enable more self-serving share repurchases. Stock buybacks, the piece explains, in theory, give prices a quick boost by removing some shares from circulation and injecting capital into the market. However, quote, the vast majority of repurchase proposals released last year were designed for equity incentives or employee stock ownership plans, which would redirect funds designated for universal cash dividends to instead benefit company executives and employees, end quote. Next up, Tesla has a growing China problem. But just quickly, if you're enjoying today's video or getting some value from it, I have a huge favor to ask, and that is to like and subscribe. This is only 2 clicks of the mouse, but it is a huge help for me, and it's the best way, along with sharing the video, of course, to help the channel grow. And for those who want to help keep the channel financially sustainable, Patreon and Buy Me a Coffee links are in the description below. The channel relies primarily on subscribers to keep going. Thank you so much, everybody, for the ongoing support. Let's continue. US EV company Tesla Inc. has announced that it will showcase its futuristic-looking Cybertruck during a promotional tour of China, where it is facing stiff competition from local car makers, especially BYD. While the Cybertruck isn't available in China, the tour will go to several cities in the mainland to build brand hype. It also announced modest price cuts to current models on sale in China. Growth in China's EV market is projected to slow for a second year in 2024 as the country's economy continues to perform poorly. According to a new report from earlier this month, the China Passenger Car Association forecasts that shipments of EVs are projected to increase 25% to 11 million units this year, which compares to 36% growth in 2023 and 96% growth in 2022. Tesla has bet big on selling to China's massive EV market. Selling 1.81 million vehicles worldwide in 2023, half of these were shipped from its Shanghai factory. However, it may have a growing China problem. This week, Japanese financial media outlet Nikkei Asia reports, citing unnamed sources, that a growing number of government affiliates, local authority agencies, highway operators, and even cultural and exhibition centers have restricted Tesla cars from entering their premises since last year. Previously, these restrictions were generally only limited to high-level government buildings or military bases. One example, the outlet writes, is the Grand Halls in the heart of the North Bund district in Shanghai, a conference center operated by a state-backed enterprise that hosts cultural events, international exhibitions, and banquets. There is nothing militarily sensitive about the venue, or at least it doesn't appear to be. Tesla cars are barred from entering the grounds of the Grand Halls, even if they are just passing through, due to national security risks, according to local residents. This is a problem. If there is a growing number of places where Tesla cars are not permitted to drive, this directly impacts consumer decision-making. A Chinese household will not want to drop a lot of money on a new car if there are wide parts of the city where they cannot drive it. This, of course, is a problem for Tesla, but it's also potentially a big problem for China too. As we know, Chinese EVs, supported by massive subsidies, have been selling in large numbers around the world, but especially in Europe. This has already provoked a subsidies probe from the EU, which China has loudly criticized as unfair. Indeed, just this week, China's ambassador to the EU, Fu Cong, in an interview with US-based Bloomberg, expressed, quote, "Everything seems to be harming the EU's security, but the question is, where do you draw the line? And where are the boundaries? And how do you strike a proper balance between the economy and security?" End quote. But now, by banning Teslas from sensitive and in some cases not too sensitive spaces across the country, Beijing is saying that foreign smart vehicles are legitimate national security concerns. This gives the EU and others the perfect justification to ban Chinese smart EVs on the same grounds. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a good Thursday, and I will see you all tomorrow.